about large scale projects. Okay, how they are managed, how they are financed. Okay, so we are going to understand about project finance. So it involves, are you able to see the screen? Yeah, it's there. So it involves high upfront capex. It has a long construction period. Okay, and operating period. That means you can operate that asset for 20 years, 30 years, 40 years to produce the output. And there are multiple stakeholders. Okay, we are going to discuss that, and we have discussed last time also. And there is a predictable long-term cash flows because these projects have complete tie-up for the customers, everything. So they have predictable cash flows. Okay, so as some students have joined today, so you'll understand that how they have predictable cash flows, but little later. So they are like these projects are of various kinds, power plants. Okay, which can be on thermal power plant based on coal fire plants, or it can be based on solar or wind or water. So these are the examples of some of the large capex projects, okay, which are basically based on producing power. Then we have highways, airports, metros. Okay, they also require a high capex cost. And then we have oil and gas fields. Okay, fine. Then we have mining and industrial parks. Okay, I'm just moving a little fast because we have done that, but just for those benefit of those who have just joined today. Okay, then these are the industrial parks because they are all parks which have a lot of facilities. The power is there, roads are built, infrastructure is developed, and then industries can set up their businesses in these parks. They are generally developed by the state governments or the central government. And then now these are the summary of what we understand. What are the large projects? So investments. Just go through this. Okay. So they involve high capex. I've already covered. Long gestation period, and there is a company. There is a new entity which is formed, which is called the special purpose vehicle. Okay. A new company, a corporate entity is formed. And the project is, handled by that company. So it's a limited liability company. So, and it handles the project. It is not handled by the existing corporate company or the sponsors who have already running the business. It's a separate business altogether. And a new company is formed. It's called a special purpose vehicle. And we'll understand why it is done and what is the need and how it benefits basically the sponsors, the owners, promoters, or the lenders. Okay. Then, there is a non-recourse or a limited recourse. So, which means debt is repaid mainly from the project cash flows. So, whenever a company is formed for, carrying out such kind of projects, so the debt which company takes, okay, the sponsors or the owners or the promoters, they bring in equity and they borrow money from the banks, and the banks are repaid their loan out of the project cash flows. Okay. And those, lenders, they have only recourse of the cash flows and the property or the equipment owned by that SPV. Okay, so they can't go and, in case if the cash flows are not, enough, or if the company is not doing very well, so they can't have, they can't go and get their money from the other assets of the sponsors of the company, but they have to, all their dues will be paid or met through this SPV, either the running stream of income or through assets what they own. Okay. So now, the risk is allocated. Whenever a new project is formed, the risk is allocated because, whenever you do business, there is a lot of risk involved, isn't it? So all risk is distributed through contracts. Okay. So there are a lot of contracts, multiple contracts which are formed, and most of the risk is passed on through the contracts. And we'll discuss that. Then, they have revenues often backed by long-term contracts. So generally, whenever a power project is made, so there are long-term contracts made with the off-takers or the prospective customers who are going to take the power, this thing for long-term, for 30, 40 years till the power plant lasts. And the company is assured about the revenue. Okay. So they have revenues often backed by long-term contract, like power purchase agreement is done between the company who's going to be producing power with the off-takers or with the customers. So it's not like a normal business where it depends upon what will be the demand and how the product will be sold. So there's a lot of uncertainty involved. Sometimes the demand is high, sometimes the business is cyclical, it does well, sometimes the business is not doing. So here there are contracts, whatever this project is being formed for, the output is already been sold out. Okay, like a power plant where all the power was sold out to, or 50% of power was sold out to Metro, Delhi Metro. So they are going to take the power for running their operations. So their company will have a long-term agreement with them. Okay. So non-recourse lenders can be paid only from the project cash flows and assets, not from sponsors' other assets. So here, the sponsors, they only their liabilities to the extent of money they have deployed. That is the equity. So at the most, they can lose only the equity. Okay, of what they have put into this project. No other form of other businesses what you are doing, and suppose they are doing other businesses, and the income cannot be used, or assets cannot be applied for fulfilling the requirement of this debt which they have taken under this SPV. So risk is distributed in project finance. Each major project risk is allocated to the party best able to manage it. Okay. And this allocation is legally enforced through contracts. So that means there are a lot of contracts being entered at the time when the project is formed to make sure that all the risk is taken care. Okay, so the lenders are very happy because they will be assured about their loan being repaid in time, because they have a lot of things to back on. Those agreements like power purchase agreement is assuring a regular stream of income. Okay, so apart from that, there is there are a lot of risks which are involved, like construction risk. Whenever a new project is formed, okay, so the risk is whether the quality of construction is good, whether it has been designed properly. Okay, so the cost overruns because of delay in the project, poor quality of the asset being made. So this is allocated to a EPC contractor. So there is a contractor which is called EPC contractor. Okay, the biggest contractor in India is L&D, which is called an EPC contractor, which is engineering, procurement, and construction. So they are going to design, everything, do everything for the company, do the construction, procure all the material required, and construct the asset within the time frame, okay, of a good quality, so that it can produce the desired output which is required from the business. Okay, so they take the entire responsibility. If there is any delay or any bad output being produced, so they'll be responsible. So they have to pay the money if company is not able to deliver the product in time, or the project has been delayed, or there is some bad workmanship, whatever. So they are responsible. So the lenders can always step in and ask the EPC contractor in case if there is any kind of a loss happening to the SPV or the company because of their works. So EPC contractors bear the risk, not the SPV or the lenders. So here, it is not the promoters who bears the risk here. Normally, whenever you start a company, and all the risk is on your shoulders, isn't it? If you are the owner. But here, the SPV only puts in money, the equity, whatever money they are putting, they can only lose that amount. Okay. Of course, that is a big amount, but not more than that. Okay, if there is any loss, anything, so it will be covered from various contracts. So EPC is one of the contract which the company is going to enter with. There are about, yesterday we were talking about, there are about a lot of companies in India who are doing this job of EPC. And there are about 117 companies which are listed in the stock exchange itself. Okay, and the top company being the L&T. So I'm just going to take you to that place again to understand. So there's a site which you might be full aware of. This is called the screener.in. So if you must create your login ID. So I'm just going to Larsen & Toubro first. So this is the company which is an EPC contractor. So if you can read, Larsen & Toubro is a multinational conglomerate which is primarily engaged in providing engineering, procurement, and construction solutions in key sectors such as infrastructure, hydrocarbon, power, this thing. Okay, so this is a company which is doing the business. And then we talked about so if you see other companies, so there are about 116 companies which are listed on the stock exchange. Okay, so the top 7 or top 6 or top 7 are coming on the screen itself. So Larsen Tuber is one of the biggest. It has, a market cap of 5,73,000 crores, and all other are very small in comparison. Okay. So, so we go back to the slide. So that means the EPC contractor is going to take the risk of the construction and the quality of the asset being produced. Okay. So that it can produce the desired output. Now, after the plant or the asset has been made, then it has to be run by someone. Okay. Somebody needs to maintain it operationally. Okay. If there is any kind of a maintenance or operation requirements are there, so that is called operating risk. So when you do, start your plant and business, so then you encounter with the operating risk. Of course, like operating risk, the plant is not being run, for 24 hours or whatever odd number of hours. So there's a lot of downtime. Okay. Okay. And so that means there is some risk of, the downtime, which was actually envisaged that, out of so many hours, the plant will run for 90%, but it is running only in 80% capacity. So it's running 10% below. So that risk is taken care by the O&M contractor. So first we have the EPC contractor, then the second contractor is called the O&M contractor. So poor performance, high operating cost, or high downtime. Okay. So if anything happens and the plant is not able to produce the desired output, and any loss arising of such kind of an event will be allocated to O&M contractor. So they are going to maintain and run the plant and see that the plant is producing the output at whatever, things which were, earlier agreed as per the agreement, what will be the specifications, and, how the plant is going to operate, what will be the downtime, agreed downtime, what will be the, the various kinds of other parameters, engineering parameters. They are all been first thrashed out, and the plant is being now run under the guidance of, or under the, this thing of operating O&M operator, contractor. So stable operations, predictable cash flows, and lenders comfort. So all this gives a lot of comfort to the lenders, because, they know that, all these risks which are usually associated with the business, they have been taken care either by the EPC contractor or by the O&M contractor. Then we have the revenue and the demand risk. Whenever a business is done, there is always, that, who will buy the product. But here this all has been allocated to the off-taker, okay, or the government. So like, we have power purchase agreements in case of power plants. Okay, fine. Revenue becomes contracted, not market driven. So your revenue is taken care, your operation is taken care, plant has been of quality, which will make sure that it runs in a manner. So that means that lenders are happy, the promoters also, are secure. Okay. So in project finance, risks are not avoided, they are contractually assigned. Okay. So now this was the slide on which we, ended last time. So risk distributed through contracts. So financial risk. Okay. Risk, inability to service debt. That means the company is not able to service the debt because company is not producing the desired cash flows to meet the requirement of the principal repayment as well as the interest on the loan which the company has taken. So like, when you take a loan, you have to pay two things. I mean, there are, yearly installments or a monthly installments are made, or a quarterly, whatever. So, which includes the principal as well as the interest. Okay. Deepak? Hello? So, allocated to sponsors, limited. So, financial risk of the sponsor is only to the extent of equity which the company is provided. Okay. So, they have the risk only to the extent of what capital they have put into the project. And the lenders, it's structured. The lenders, structure the things like that so that they are comfortable, because they already been, all the risk has been taken by various contractors, but they structure the loan in such a way so it's called debt sculpting. Okay, the number one. So we'll understand what is that. Then designing the loan principal repayment schedule so that the debt repayments closely match the project expected cash flows, ensuring stable debt service coverage ratio. Debt service coverage ratio is basically, like this. So debt service coverage. No, generally I'm not very good in spelling, so I can always make mistakes. I have to that already here. So DSCR. Okay. So there is something called interest coverage ratio. Okay. We are understanding debt service coverage ratio. Okay. Which is basically the cash flow. CAC. So the cash flow which the company is going to generate for which is available for the loan repayment. So cash flow CFAD is called. Cash flow available for debt service. Okay. So which is basically, the company, if you look at the company, we calculate first EBITDA. Okay. So this is this proxy to cash, the cash profit to the company is earned. Then we minus what? We minus a couple of things. One can be the change in working capital minus taxes minus the maintenance capex. So if you do all this, you will have CFAD. So we take the EBITDA. Okay. That means the sale minus the operating cost. We get the EBITDA. We'll do some questions, so we'll understand that more. Minus the taxes, the income tax which the company is paying, minus the change in working capital, minus the capex. Now, if suppose the solar plant, okay, now solar plant has been made for about maintenance. That means if suppose that is what I was going to tell about. Suppose you have made a solar plant, big solar, which is producing about say 750 megawatt of power. So you have put all the solar panels, you have bought some inverters, okay, and other electric or something civil cost, everything you have done. Okay, so you have produce the plant. Now, after certain years, you only remove, you change the panels. So whatever you're doing, you're maintaining. You're not adding any capacity because it's already to a 750 megawatt, and that is the desired for the next 30, 40 years. Unless you think about another, so then you start up another project, another SPV, and add a new asset there. So in this asset, there will be only maintenance capex which will be done. That means you're going to change the solar panels, you're going to buy new inverters, the inverters which have become, obsolete or which have been worn out, or the solar panels need required to be changed. So we have the maintenance capex which needs to be done. So after that, so the taxes, whatever income tax you are supposed to pay, you pay that. So the cash will go out. Then some amount of capex which you'll be doing to maintain the already an existing this thing. So if you look at so there's a case study which we'll be doing later on. So if you look at here, so if you look at a power plant, so there are solar panels. Then we have the inverters. Okay, the solar panels convert sunlight into direct power. Then the inverters convert the DC into AC power, and then it is fed into the meters. It's metered. How much units you are producing. Then it's been given to the for distribution to the electrical energy distributed directly to the utility grid. Okay. So what you are going to do is you are going to only change the solar panels or the inverters finally. Okay. So these are the two things which are, or maybe three is the meter, and there can be some electrical items and other things. So only you're going to maintain that. If you look at a picture of that. So this is a kind of a solar. So there is a land on which you put all these solar panels. Okay. Fine. So okay, so we come back to our slide again. Okay. So we have the debt service coverage ratio. So we calculated this thing. I mean the CFAD. So we have a lot of numericals where we will be doing. Okay. Then we divide by the total debt service. which is nothing but the interest plus the principal. Fine. So we get some kind of a ratio. Now, normally for a power project, it should be around 1.3. No, that's a benchmark. 1.2, 1.3, 1.4. It's a more riskier project, then this goes up. Suppose it's like a telecom project or some other kind of a project, it will be 1.5. Because this will decide, uh, the lenders will talk about this ratio. They will, based on this ratio, they are going to give, the loan to the company. Fine. So CFAD upon the total debt service is 1.3. So this is basically how much the company is able to generate. How much more than, it's almost like, it's producing, say, 100 it's 30% more within the sale, more than the total debt service. So the lenders are comfortable with this kind of a ratio because they know if there is some kind of a drop in the revenue because for some other reasons, so still they will be able to manage to get their money back from the company. Is that okay? So let's talk about. So I've just added some, just revised some slide. I'll share you the revised ones. Okay. So this is the key financial and credit terms. So first we have this debt service coverage ratio we talked about, which is, the CFAD divided by the total debt service. So measures ability to service debt. Lenders typically require 1.2 to 1.3. Okay. The CFADs are cash flow available for debt service, which is EBITDA minus the cash taxes, minus the maintenance capex, minus the working capital. Okay. Because sometimes when you are selling, you may not get upfront all the money from your customers. So some money is tied up in your working capital. Okay. And similarly, you are also buying certain things from your suppliers for certain things, and you are also tying up their money. So it is a net. The working capital is how much money is being blocked into the business each time. As the business grows, so working capital generally goes up. Okay. So that means it is eating away your cash. Are you aware of that? Everyone? So what is, if I ask you what is working capital, so what does it mean? Can you just say, yeah. That is the normal thing which I get from everyone. So, okay, I think I will get the same kind of a reply. So, working capital is basically when you do business, what happens is you require two kinds of capital. One is a capital for buying assets, okay, which you are going to use them and produce your output. The second kind of asset is the money which is tied up into the business when you do business. Like, for example, suppose you are, just take an example of Marks and Spencer store. So, when you go there, okay, so if you ask them how much, kind of inventory they have at any given point of time, they'll say it's all 5 crores. So that is the money which they're invested. And that money is tied up into their inventory. Because without that inventory, they can't do business. They can't keep the showroom empty so that you go there and say, I want to trousers. Say, okay, we'll get from our store. So that's everything's on the display. So all your working capital is tied up into the business in form of either inventory. Okay, so you need that inventory, so you require that capital to run the business. Then, when you do business, when you sell your goods, you don't get the money upfront from your customer. If suppose the business said that you're giving 1 month credit or 15 days credit, depending upon from customer. Okay. Now, at any given point of time, your some money will be blocked in form of receivable. Okay, so that was required to do business. Without that, you can't do business. So each time, a lot of money will be sunk into the business in form of inventory, in form of, receivables. Okay. So if you add them up, okay. I mean, a simple one, trading business. So it will become the working capital. If it's a manufacturing, then there will be a lot of other things very simple, the working capital calculations. So then this is working capital. Right? Okay. So the net working capital is minus the current liabilities. That means if you are doing business, some suppliers are also supplying raw material to you, goods to you, and you're also blocking their money because you're also getting some credit. So they are financing the need of the working capital in one way. Okay. Because when you buy, material from financing, like suppose you go to a Marks and Spencer showroom, it's a 5 crore inventory. But Ask them, is it bought in cash? No, 1 crore is still payable to the supplier. So that means 1 crore is being financed by the supplier and 4 crore we are financing. So any balance which is lying as a current liability is an outstanding. So we reduce that, so it's a net working capital. As the business grows, the net working capital requirements also grows because when your sales grow, everything also goes along. Okay. Your receivable goes, your inventory goes, everything goes. Okay. If suppose Master double their showroom, so they have 2 showrooms, so that means they have to double the quantity. So as your business grows, you have more and more working capital. Okay. So, and sometimes the working capital can even drop when the businesses go down. Sometimes seasonally, like winters, a lot of stocks have to be kept for certain businesses. Okay. As the winters are over, then the stock falls. Okay. So working capital is, always a plus minus figure sign is added to this. So plus would be inflow of cash. That means your working capital has gone down. Minus would be that you have actually increased your business and more money is tied up in your working capital. Is it clear? Working capital. Is it clear? Okay. Now, what else? Okay, so that is there. So that means the CFAD, and then we have the last account, which is called debt service reserve account, which we'll be talking a little later. Now, what happens is, I'll just give you, as we have the slide, what happens is that, when the company is already taken a loan, okay, and you have a good ratio, 1.3, the bankers are happy, but bank says, as per the agreement terms, they want to make sure that you are paying on time. They say, at the end of the year, before the start of the new year, so on 31st of March or whatever is the last financial year, you should have some reserve, okay, a 6 months reserve equivalent to whatever money you have to pay to us. Lying in a bank now, where you can't take any money out, we can only take money, or that money will be used only to pay their loan repayment, both interest and principal. Okay. So that means some cash balance or bank balance, which the company cannot use for any other purpose, but it is only being used for paying out to service the debt. Okay, so it is basically additional security. Okay, so debt service, the cash reserve equal to 12 months of the debt service act as a liquidity buffer for lenders. So lenders can have only the first right on that asset. Okay, so they're shown as in balance sheet as bank balance, but with a note that this balance is not free to be used for company purpose. It is only for meeting the loan liability requirement of the next year. Is that okay? Now, so this is basically now we come to the debt sculpting. Or debt sizing is also there. So two things, debt sizing and debt sculpting. Now, the bank may decide, how much maximum loan it can give. How much loan the bank can give to you. So the bank has to decide that. Then the debt sculpting is a process of designing the loan repayment schedule, principal plus interest, so that the debt service closely matches the project cash flows. Okay, because the company is going to run the business and produce cash. The cash can be uneven. Maybe at the begin with the cash is less, but the cash goes up as the business progresses. Okay, because the full tie-up or full customers, they start buying everything. So it takes some time to pick up the cash flows, go up as the business goes up. Okay. While maintaining the target DSCR. So bank says this is the DSCR. Okay. So that is fixed. But we are going to now make the loan in such a way that you maintain the debt service coverage ratio also for the loan life. Okay. Because suppose the loan is given for 12 years or 10 years, so around the 10 to 12 years, you are maintaining this debt service coverage ratio. Okay. And the total debt service, that is the principal and interest, will be decided based on your cash flows. Okay. So it draws a pattern from whom you're generating your income, and it is based on another parameter which is called the debt service coverage ratio. So all in combined, a model is made on an Excel sheet, and the bank decides, how much maximum loan the company can give. The bank can give to the SPV or the project owners, the sponsors, and how it is going to get repaid. So here I just share a file also So I am just going to open that. Though we did last time, but uh, so this is debt sizing. So this file I have already shared. So if you want, you can just open in your Excel after some time, and then you can just do your own this thing. Okay. So this file is a model which has been prepared. Okay. So this is the bank has a template. Now this is what blue. So blue is basically all inputs. So you have to put all the inputs, and the debt amount will automatically get populated. So you'll get the debt. How much debt can be given? So which means the debt period 12 years. So here, in the input we have decided that the debt will be for 12 years. We can always change that. Okay. Then the interest rate is 9%. The bank is going to charge you 9%. So it will all depend upon what kind of a loan it is, how many years it is. So for each and everything it will separate. So this is just an example here. Okay. Then the target DSCR is 1.3. Okay. Now the DSCR can be either individually for each year, or it can be for the entire loan life, right? Based on how much cash flow the company is going to generate and how much is the debt service. So you can even calculate the loan life DSCR. Okay. Then, so we then use the discount rate. So discount rate is basically nothing but the interest rate which you are paying to the lender. So we use that to calculate the present value of all the cash flows which company is going to generate, number one, and all the debt service EMIs or the principal plus interest yearly installments, you calculate the present value. Okay. So what you do is you take you divide instead of dividing the CFAT, you divide the present value of the CFATs for the loan life and divide by the present value of the total debt service. So you will get the loan life DSCR ratio instead of the single 1 year. So you can do it for the full loan also. Okay, fine. So I'll just show you here so you can understand. So you picked up 1.3. Now once I have explained, we will change the number and find how it reacts. So then we have the first is CFATs. So this is the number which is given to you. Okay. Fine. So there are 12 years. So you have taken only 12 years because the loan runs for 12 years. Of course, this project can be longer than 12 years. Okay. So this is, the cash flow which company is going to generate every year. Okay. 30 crores, then 32 crores, 34 like this. And the 12th year, 40 crores. Is that okay? Then we go to the debt sculpting. Okay. Now this figure which was been populated here in the inputs automatically. So it will be picked up from here at this first opening debt. Okay. Then interest, which is your 9% on the loan, 197.2. So we calculate that. So this is B3 in B4. B4 is the interest rate and this is B3. So automatically, so then the target debt service, because it is 1.3. So we know we can calculate what will be the total. And principal is the balancing figure. Principal is the balancing figure because the target debt service is based on 1.3. So it has been automatically calculated in the Excel sheet based on how much cash flow you are going to generate. So it is the cash flow divided by 1.3. So you will get the total debt service. Okay, fine. So then we have the closing balance, which will be nothing but the opening debt minus the principal repayment is equal to the closing debt. So interest is separate. So, and the DSCR is maintained at 1.3. So every year the DSCR is maintained at 1.3 in this. Okay. So is it clear? Yeah. Okay. So we'll come to that. We'll come very soon. We'll come to that. So just park your question. We'll understand that. So then we have, then I told you this thing that we'll answer it as we go along. So you'll get your answer. Okay. Fine. So then we have, the loan life DSCR, where we take the CFAD and the debt service, which is the principal plus the interest. Then we can take the discount factor, the interest rate, and calculate the present value of both the streams, the debt service as well as the CFADs. and we get this number 1.3, which is basically derived from here. Is that okay? Is it clear? Now we go to the debt sizing. Okay. So this figure is coming 197 crores. Okay. So already we have done it. So it's coming here. Then it is 1.3 and the closing debt balance is 0. Okay. Fine. Now what we do is we change the CFATs. Okay. Just see. Suppose I make it, like 35 and then, I make it like this up to 30 and then I make 50 out here. Or rather what we do is, debt sizing is 0. Yeah. Suppose I make it to 1. The lenders say that, they are comfortable with 1.4. So we'll make 1.4 here. Okay. So we made 1.4. Okay. Now let's see the debt sizing. The debt sizing, we are not getting 0 here. We should have got 0 because after the debt sculpting, everything should have been paid. But since there is we have changed this thing. So what we'll do is we have to decide, how much loan can be given. So for that, I'm putting my number here and go to, go to data. Okay. And go to what if, go to goal seek and, make this as 0, this figure as 0. And depending upon the loan. So the loan has to change. Okay. So this figure has to change. So this becomes 0 and now we can go and see the loan. So the loan is 183. Now, why the loan has come down? Anyone? Yeah. Why the loan has come down? Loan कम क्यों हो गया पहले से? Loan कम क्यों हो गया सामने? Why the loan has come? Dropped down. Why the loan has gone down? Because the increase in the DSR. So DSR ratio, DSCR ratio has gone up from 1.3 to 1.4. So banks are will not be able to lend the same amount. So they're going to lend less. Okay. So it has become 183. Is that clear? So up to now, this is clear. Okay. Now we'll just move out of this for a while. Okay. Because the project has, when you are doing projects, there's risk involved. Okay. A lot of risk are involved because sometimes you are sourcing some things from outside. You are being exposed to dollar or pound or yen, foreign currency risk is there. Okay. Or your customer is abroad and you are supplying the goods to the other person, and the dollar can go up and down and can change your. There's a risk involved in your revenues. There's a risk involved in your cost because if you are exposed to some kind of a risk in sort of in terms of the foreign currencies, or you have taken a loan with the interest rate goes up, okay, and you have taken a floating loan, so you have to pay more fee. So there's a risk involved. Okay, interest rate risk. There's a risk of commodities. Like if you are buying, the solar panel price may go up. Okay, fine. So there's a commodity risk. Interest rate risk, there's a foreign currency risk. So a lot of risks are there. So how do we manage the risk? Right? Let's go and manage that.
Risk mitigation multiple other options.
So derivatives. So that means you can use even derivatives to manage your risk. Okay. So derivatives पढ़िए आपने? कब पढ़ा? Last class? Good, very good. So it's good that you have read derivatives. My job is become easier. Okay. Now, so was it confusing or was it interesting? कैसा लगा सब? बहुत अच्छा? That's very. So you've done your options also? Oh, fine. So futures, forwards, options, and swaps. So these are the 4 derivatives which we are using to manage the risk. Okay. Now, interest rate swaps, done. The Sonia or LIBOR. अब उसकी जगह सोनिया आ गया ना, तो you done LIBOR or you have moved on to the new benchmarks. Okay. So you did Sonia or LIBOR? LIBOR. So LIBOR is phased out. It's not being used at all now from last few years. Okay. So now we have another new benchmarks which have come. Okay. Fine. So we'll talk about that. And SOFR, SOFA, Estonia. So these are the new, interest rates. So what is LIBOR? What is a LIBOR? What if I ask you what is a LIBOR? So what will be the answer? LIBOR क्या होता है? LIBOR क्या होता है? LIBOR क्या होता है? Somebody can answer me. London Interbank offered at LIBOR. So what does it mean? It is a short-term interest rate from one bank to another. So if one bank wants to borrow from another bank, so it is a LIBOR. So LIBOR is the rate of interest which is used based on it is a short-term lending rate. It can be 1 month LIBOR, it can be a 2 months LIBOR, it can be a 3 month LIBOR. So it is an interbank rate. When one bank wants to borrow money from another bank, it's called. They say how much is the interest rate you will be charged? So that interest rate is in short term called LIBOR. Now, how the LIBOR was decided earlier? So there was, in long days, there was something called British Bankers Association. And after that, another association came. So what they used to do, they used to pick up a phone in the morning and call up all the major banks in the world, okay, or within England, and ask, if suppose, you have to give loan to another bank for 1 month. How much is the interest rate you are going to charge? Okay, fine. Then they used to make an average of that. Take out the outliers and make an average. Suppose it comes to 2% or 3%. So that will be the LIBOR. Then they will, declare it on through Reuters or through web channels. They will declare this is the LIBOR for 1 month. This is the rate of interest which the banks are charging on an average from each other for short term. Is that okay? Fine. So it was based on a phone call conversation by an association, making calls to various bankers, and then note down all those interest rates and exclude the outliers and make an average. And then they will publish those rates as LIBOR. So LIBOR for 1 month, LIBOR for 2 months. So for all the kind of scenarios, like 3 months, if somebody has to take a loan, how much rate of interest you're going to charge. So they have all this information, and those rates of interest were declared in those days. Now, this was subject to a lot of manipulation and a lot of scamming happening across the country. Okay, so then it was decided that we had to move out of this whole thing. In India, it was called MIBOR. Because here, the MIBOR, was the National Stock Exchange which was collecting of information, the same what the British bankers were doing, and publishing the MIBOR, Mumbai Interbank Offered Rate. Similarly, for Turkey, it was TIBOR. For major world, there were different names for short-term loans. Now, if suppose I am a customer, I am a corporate guy, and I need a loan. Suppose I am, representing Reliance. Okay? So I require a 1 million loan or a $500,000 loan or whatever amount. So I approach the bank and say that I need a loan. So how much you are going to charge? Okay? They're going to say LIBOR plus 2%. That's the spread. Because LIBOR is the cost. And they have to earn something on that. Whether they're using own money or whether they are even borrowing from someone irrespective, that is the cost of capital. So they are going to say LIBOR plus 2%, LIBOR plus 3%, LIBOR plus 5%, depending upon the borrower. Suppose it is Reliance, they're going to say LIBOR plus 1. But it's a small customer, they'll say LIBOR plus 3. The more, chances of credit defaults, the LIBOR plus spread will go up to cover that risk. Okay. Now, that LIBOR got changed to a new benchmark very recently, about 2 to 3 years back. And that is, now this was based on the transactions, this was based on a phone call. So then it was decided it has to be based on actual transactions, which are happening in the market. Okay. So a new benchmarks have come, which are based on the transactions happening in the bond market. Okay. Based on that, so we have, Estonia, which is now in England, like LIBOR has replaced Estonia of England, and then we have SOFR, which has replaced the LIBOR of USA. Okay, so each country has their own set of short-term deposits. Okay, now So interest rate swaps we have already done. Okay, so I'm not going to do that. Okay, so there are, who are the people who are investing in the stock market? Who invest their money? Who are the category? What are the categories of people who are investing in stock markets? Anyone there? Karan? Huh? FIIs and DIIs. So we call them in short FIIs and DIIs. FIIs are the foreign investor, institutional investors, and DIR is the domestic institutional investors. So what would constitute a DII? If suppose we have to break up the money getting into stock exchange, what will be the total categories involved in DII? Name one. HNI, yeah. Insurance funds. Okay. Mutual funds. Mutual funds. Okay. What else? S. SIP. SIP. So that all mutual funds. So mutual funds are investment. So mutual funds, total FII money which is pouring into the stock market, out of that 60% is all coming through mutual funds, pension funds, provident funds, okay, and financial or insurance companies. So they have a lot of money, so they keep pouring the money into the stock market. So that's altogether called DI. Then FIA, the foreign institutional investors. Okay. The foreign participants, FPI and other people. So they are putting money. Now, if you look at FIA and DI activity in the stock market, okay, now 10 years back, we were heavily relying on FIA. A lot of money was coming through it. And the DII money was very less. Today it is the DII money, which is the maximum amount of money, because today everyone, the youth who start earning, they start putting money in mutual fund. That's SIP and other rules. Everybody is putting money in mutual fund. This happened in the last 2 years or 3 years at the max. And what is the trend? Look at this. So what I do is that I make it yearly. The FII cash. So FII can bring money in cash. There are two segments of the market. One is the cash segment, which is called the capital segment of the market, where the money comes in form of people buying shares and they are going into the demat account, and then you hold those shares for a long period of time and then sell them and make profit. Okay, so that's called cash segment. The other is called the future and options segment. Okay, where we have all the speculative part of the business. Okay, so if you look at the money which is being coming into India, or rather the money being thrown out of India, is like this. In 26, 4,000, it's about almost like 7-8 days, 4,560 crores have gone out of India. Almost like, close to about $500 million. $1 billion is close to about 9,000 crores. Okay. So half the money, $500 million has gone. Then in 2025, it was 3,06,419 crores which have moved out of India. And how the Indian markets have performed? Indian markets have gone straight down. Despite the FII selling almost to the extent of almost like $32 billion have moved out of India. Okay. So if you take this figure and divide by 9,000, we'll have $32 billion. Isn't it? And 2025, again, the same amount, and the stock market has gone up. Now, earlier, the trend was if the FII was selling like this, the market would have crashed. Okay, the market is not crashing because it is getting supported from the DII. DI is putting much more money than the FI. How much, how much money DI has putting? Any approximate? It's about $80 billion per annum. Or almost like 60,000 to 80,000, we'll just see the number, okay? So it's about 60 to 70,000 crores per month form of SIPs and mutual fund contributions from the people who are working. That money is going into the market and supporting the market. So if you just go back and see the numbers, so there were some positive numbers earlier in 2018 and 19, but when we look at the number here and see the DII cash, so this is what the money is coming from the investors. Okay, the mutual fund majorly 60% of the money is coming from small investors, separate. Okay, people who do the MBAs, who become doctors, engineers, they start working. Everybody is now putting the money in stock market through mutual funds. 5 years back, nobody was doing it. Okay, because the stock market was considered to be very risky. Okay, now everybody like to take risk because they're making money. Okay, so how much money is coming? 78 lakhs. Okay, divide by 9,000. So how much will be? More than $80 billion is being coming into the market by the Indian investors. Earlier, we were thinking that how much money we will get from the foreigners, and they will push up our markets. When I was young like you, so we were saying 1 billion आ गया बाहर से. We were happy. अगले साल 2 billion होगा. We were, and nobody was putting money in India. If I talk to my father or my somebody, he says it's a risky thing, nobody invests in stock market. So nobody was putting. The youth was not putting money. It was only the speculators and the people who were putting the money. Okay. So if you see the flow, so there's a huge flow, which started in which year? So actually we see 2024, 2025 and 2022, 2021 was almost a beginning. Okay. And 2022 we started getting money in good form. So it's just a 3 years back only. Before that, everything was dependent on the FIA flow. But now it is all depending upon our own internal flow. So if this money would not been there, the Indian market would have gone down by 20 to 30%. We would not been there. No. So the best part is that in America or the Western world, almost 70 to 80% who are earning, they're putting money into the stock market. In India, it's about 30 to 40%. They're just started. So we have a long time to go. So it's a structural change which has happened in India, and this monies will keep going more and more as the time progresses. So the markets are not going to fall. Like it's not these flows will not get reversed so easily, because there are so much of people who will be entering into the market. So it's a structural change, and this figure is going to go up. As this figure is going up, gradually from 5,26,000 crores to 7,88,000 crores, and it was 1,84,000. So there's a phenomenal growth which is happening. Almost which has happened to the extent that 40% of the youth of India has already put the money. Now there is another 32% who are waiting, who are just going to awake to this thing that the markets are going to do well and India is growing. So if they buy the Indian story, so this flow will keep growing. Otherwise, if suppose the other some asset like gold also, which has done a very good phenomenon, but gold is not going to do so well. It's a kind of a blip which has happened in the last 2-3 years. It's not going to perform like stock markets, okay? Because it's not an economic asset. Okay. So now what we do is that we understand this is the DIA cash. Okay. Now we have the FIA. FIA, future and options. Let's understand that. So we have future and options here, index futures. Okay. Then we have index options. Then we have stock futures, and we have stock options. So there are 4 subcategories in the options trade. One is called the index options. Index options mean Nifty, Bank Nifty. Okay. All those index, popular indexes where you can bet off that Nifty will go up, so I'm going to put money in it. So that is through future and options. So that is called the index. In FI index options. So here options, instead of doing a futures, you do the option. Okay. So you have 2 ways. So when you are bullish, what do? You buy calls or buy puts? Huh? You buy calls. When you're bearish, you buy puts. And when you are bullish, you buy either calls or you sell puts. Is it? And when you are bullish, when you are bearish, you buy calls, you sell calls or buy puts. Okay, fine. So, so there are four possible trades. So index options you will find. Now we'll just see the first futures. Index futures. So index futures, what is FI doing? Of course, they have become slightly positive in the last few days. Okay, but last year, last year, they were heavily shorting Indian markets. Okay, 2025, the 81,606 crores was, being in the futures. So there have been this thing. So, there is something called long short ratio. So they were 95% short and 5% long last year, last year. And last year at the fag end, they became 88% short and 12% long. And today, maybe we have to see the data. So the trend is changing. Now the FI is going to change their view. And maybe as the results starts pouring for the last quarter, when the GST was, slashed, the income tax was reduced, so the demand has gone up. So all will get reflected into our, annual, performance of all the companies, and the companies are going to show a good performance. So these FIs will start now, take a positive this thing towards India. Maybe it will take some time. Still, they are not so, bullish on Indian market. Because why they are not bullish on the Indian markets? Why they are not buying? Why they're selling? Why they're what they're doing then? Indian markets were very good. FI used to put a lot of money. So where they are gone? Where they are gone? How they have exited Indian markets? If they are selling here, where they are buying?
In the US
Huh?
in the US Treasury bond.
US Treasury.
Because the exchange rate are not favorable for them.
Yeah, that is because the exchange, because they are selling, so that's why the exchange rate, the exchange rate is, the dollar is appreciating because of the lot of selling by the FIs. Okay, but why they are selling and where they are pouring the money? They are going to Taiwan, they're going to, Korea, they're going to China. If you see, Korean market, Kospi, has gone up by 80% the last year. Okay. Just see, Kospi has gone up by 80%, 70%. Hang Seng has gone up by 30 to 40%, or maybe about 14% last year. The US market has also gone up. So they have found other markets. Okay. But some of the markets are still below their lifetime lows. Okay. So Indian markets are doing very well. Even despite, kind of a lot of outflow which has happened, still we are growing at 10%, 15%. And our returns over the last 5 years are far better than any other market except the US. Okay. Because on a cumulative basis, because 2023 October the market touched the all-time high. Okay. So it has run out of the fundamental, out ahead of the fundamental. So it has run very fast. The mid caps, the small caps, the large caps. So our valuations have gone up to 23, 24 times, the PE ratio. Okay, which was a very high PE ratio. So we become very expensive. So other markets became relatively very cheap. And like Korean market, they started doing well. The economy started doing well. The Chinese, they also started recovering a bit. So they found that there are other markets where they can put money and make more money out there. And Indian markets are already very, very expensive. Right? But if you look at 5 year in context, we are still, we are given the better results. Okay. Okay. So we come back to the subject now. And we'll talk about little derivatives because how do we manage the risk of the projects. So that was the only purpose to just talk about the derivative. कितना टाइम रह गया इस क्लास को 10 minutes. 10 minutes. So we'll have just 2 minutes, we'll have the attendance done. So that scalping हो गया. Okay, this is okay. This we have done this slide. Last time we actually got into this. And yeah, you want to say one in something? Okay.